While the hyperscalers are throwing nearly $700 billion at AI this year, Applied Digital just proved you don't even need to build the power plant to cash in. You just guarantee the guys who do. Welcome to Earnings Unscripted. It is April 8th, 2026, and today we are unpacking a seriously strange fiscal Q3 for Applied Digital, ticker APLD.
It is a really strange one. I mean, on the surface, GAAP revenue looks completely flat quarter over quarter at $126.6 million, but their net loss drastically widened to over $100 million. EPS fell to negative 36 cents from negative 7 last quarter. And yet somehow their core operating profit, the adjusted EBITDA, shot up 118% to $44 million.
Which is quite the riddle. Actually, quick reminder before we try to solve that. We are just two people talking here, so please do not take any of this as official financial advice. But Miro, the market reacted exactly how you would expect to numbers like that. Just extreme whiplash on the tape.
Absolute chaos, yeah. The stock gapped up big in the regular session, and then they had this steep cliff dive sell-off right during the 5 o'clock earnings call. Bottomed somewhere around 25.60 in extended hours, but it actually still managed to hold a roughly 5% gain overall from the prior day. And the resilience there is because Wall Street realized that the shrinking core revenue is actually the best thing happening to them right now.
Okay, so shrinking revenue is somehow a win. You're going to have to unpack that. Are we talking about the construction side tapering off?
Precisely. If you strip out the cloud stuff, adjusted revenue actually dropped 14% to $108.6 million because they essentially stopped doing all that zero-margin tenant fit-out work. Their first CoreWeave building became operational. So as that dead weight rolls off, they trade it for highly profitable liquid-cooled compute rents. That is exactly how your top line shrinks while your EBITDA doubles.
That is remarkably elegant. You shed the fat and keep the high-margin muscle. And you know what really stuck with me reading through the transcript was this tiny human story the CEO, Wes Cummins, threw in. We always assume these massive AI data centers just completely strip mine local grids, but Applied strategically built their Polaris Forge 1 site on this underutilized infrastructure in North Dakota. And just by absorbing those fixed infrastructure costs, they actually saved local ratepayers roughly $31 million on their electric bills.
Right. It is a smart geopolitical move, honestly. You get to play the local hero while locking in power for a city-sized computer. But we really need to look under the hood here because that massive $100 million net loss is hiding a roughly $60 million accounting head fake.
Oh, yes, the phantom cloud division that just keeps teleporting on and off the balance sheet. All right, let's get into the details on that.
Exactly. They took this entire cloud division, which was supposed to be held for sale last quarter, and just shoved it right back into continuing operations, which automatically triggered that massive $59.7 million non-cash write-down.
Causing it to look totally flat. I mean, anyone just skimming the headlines thinks the core data center business went nowhere. But really, they just masked the drop in construction revenue with this cloud adjustment. It is pure illusion.
Pure noise, yeah. But the really fascinating part is why they pulled it back. They are prepping a reverse merger. They are rolling the cloud business into EKXO Bionics.
EKXO Bionics. Wait, the exoskeleton company?
Yep, to form this new entity called Chronoscale, ticker CHRN. Applied gets to keep 97% ownership, but it is now technically a separate public vehicle.
So they are essentially taking their GPU cloud public through a microcap backdoor. That is honestly kind of wild.
You kind of have to, because if you look at the economics of GPU clouds right now, they are just absolute capital incinerators. You have to keep buying new chips continuously. Applied clearly does not want that hardware cycle sitting directly on their balance sheet and poisoning their high-margin infrastructure story.
That lines up perfectly with what Wes Cummins was saying on the call, actually. Let me read you the exact quote here. He said, This move positions the cloud business to raise capital independently, create differentiation, and drive accelerated growth with the long-term goal of spinning the business to our shareholders.
Raise capital independently. That is the whole ballgame. They want somebody else to fund the obsolescence treadmill.
And they sit back as the 97% owner while someone else pays for the GPUs. It is just a very elegant financial abstraction. And honestly, it feels like that exact same logic is playing out on the energy side, the new power plant deal.
Oh, you mean the base electron guarantee?
Yes, because we talked earlier about the hyperscalers spending $700 billion. You cannot run those massive new campuses on hopes and dreams. You need gigawatts of actual power.
It's a massive bottleneck everywhere. And if you need 1.2 gigawatts of power in the Dakotas today, you usually have to build it yourself.
Which costs a fortune and ruins your margins.
Right. It breaks the model. So Applied refuses to take on the physical risk of constructing a natural gas power plant. Instead, they are acting as a guarantor for an independent producer called Base Electron. Base goes out and actually builds the plant with Babcock and Wilcox. Applied just wraps the debt in a parent guarantee.
Meaning they just co-sign the loan.
Basically, they give Base early credit support. In exchange, Applied gets priority access to the power pipeline and a roughly 10% equity upside in Base itself. And here is the truly clever part. If Base Electron successfully raises $50 million independently, Applied Digital is completely off the hook for the guarantee.
Wow. Okay, so if Base hits that funding target, Applied just washes its hands of the financial risk entirely but keeps the 10% equity. That is phenomenal.
It really is. You get heavy infrastructure built for you without wrecking your own cost of capital.
I would call that having your cake and powering it too. Though I do have to ask, what happens if Base Electron cannot raise that $50 million? Does Applied suddenly own a half-built gas plant?
Legally, they are on the hook as the guarantor, yeah. But Wes Cummings explicitly noted they are not going to, I think his phrasing was, sign a bad lease just to get an announcement on the tape. They are structuring these things very defensively. Look at what they did with the CoreWeave debt for their first big campus.
You mean this special purpose vehicle they set up?
Exactly. They detached the CoreWeave lease into a bankrupt remote SPV. They threw in a $50 million letter of credit and walked away with an investment-grade A3 rating for the debt.
Which matters immensely because data centers live or die on debt. Borrowing at 9% will just bleed the common stock dry over time.
That is exactly it. Sadal Mamand, their CFO, pointed out that going from BB up to an A3 rating cuts their borrowing spreads from the mid-400 basis points down into the mid-200s. Over a 250 megawatt facility, that's a staggering amount of saved interest.
Okay, so if we take a step back here, we have micro-cap backdoor spinoffs, off-balance sheet power guarantees, and bankrupt remote SPVs hacking the debt markets. It is incredibly smart maneuvering, but where does all this financial gymnastics actually leave their operational trajectory heading into next quarter?
It leaves them staring straight at physical execution. The complex setup is done. Now they just have to plug the servers in. Management expects revenue to ramp significantly over the next year as those remaining 150 megawatt buildings step online. The energization process is staggered, so starting around July, we should see that pure rent revenue heavily hitting the income statement.
Which is the true test of the model, because the scale they are chasing is staggering. I do not know if you caught this line from the CEO, but it perfectly captures the fever dream of the sector right now. He was talking about severe grid constraints and casually mentioned the industry is exploring, quote, efforts to develop data centers in space.
Right. Orbiting servers, because getting a utility permit down here is apparently harder than orbital mechanics.
Literally. But it shows how desperate the demand is. Applied is projecting 5 or 6 gigawatts of capacity over the next few years to feed that exact desperation.
They are, yeah. And they anchored executive goals to an internal target of $1 to $2 billion in net operating income. But look, my lingering red flag for next quarter is the internal dilution.
The stock-based comp?
Exactly. It surged to nearly $49 million just this quarter. So going forward, it is fundamentally a race. Does that massive cash flow arrive before the share count dilutes the common investor? The financial maneuvering bought them the runway. Now we just watch if the plane actually flies.
A race between cash and dilution. I think that is a perfect place to wrap up. We will see if they can keep their feet on the ground next quarter. Thank you for listening, everybody.
Take care.
All right. If you enjoy having these earnings chats just magically appear in your feed, definitely hit follow on the podcast. And just as a quick heads up, Earnings Unscripted is put together with the help of AI, which is honestly how we translate hundreds of pages of dry financial filings into an actual conversation. If there is a ticker you want us to look at next, just shoot us an email to earningsunscripted@datamadness.ca or find the X link in the show notes. Catch you next time.
Catch you next time.